Now that we've had a quick introduction to the topic of the concentration of wealth, I should point out that what we'll be focusing on with this topic comes from the research of a highly respected French economist named Thomas Piketty, who, in 2014, published the book titled Capital in the 21st Century. This book made a dramatic splash, not only within the field of economics, but also within the popular press. Given the title of his book, the first thing that I should do is define what is meant by capital. Think of capital as the sum total of non-human assets that can be owned and exchanged on some market. With this definition in mind, you can see that it includes all forms of real property, such as residential real estate, as well as financial and professional capital, which includes things like industrial plants, machinery, infrastructure, patents, stocks and bonds, and so on. It's important to point out that in his definition of capital, Piketty excludes what is termed human capital. Human capital consists of an individual's labor power, skills, training, and abilities. He excludes this from the definition of capital because it cannot be owned by another person or traded on a market in any permanent way. The exception here, of course, is found in slave societies in which people and their labor were actually owned as a form of property that can be bought and sold on a market. Slaves could be inherited and were included in calculating a slaveholder's wealth. So, when taking an historical perspective, it's necessary to include slavery in calculations of capital. And as we get deeper into this topic, we'll see the tremendous impact that slavery had on wealth in the United States. Okay, now that we have a sense of what is meant by this concept of capital, let's see how the US compares with other countries with regard to capital and how that has changed over time. What we're going to focus on now is the unequal distribution of global wealth. As observed by sociologist W.B. Du Bois, there's a handful of core nations that have exploited the nations of the periphery to generate vast amounts of wealth for themselves while leaving the rest of the world impoverished. Let's start by looking at two of the major world powers of the 18th and 19th centuries, Britain and France. As a tip to help you along through this, you'll probably want to refer to your handout for this topic. If you look at the first figure, figure 3.1, you'll see a table showing the amount of capital in Britain and how it evolved between 1700 and 2010. In other words, it shows us how much wealth the nation as a whole had during this time period. The vertical axis is the value of national capital as a percent of national income, and you can see that it starts at about 700%. What this means is that at the national level, meaning for Great Britain as a whole, the value of capital in the year 1700 was equal to 7 years of income. To give you a frame of reference, the equivalent at the individual level would be for a person to have 7 years worth of income stashed away in savings, investments, and real estate. In other words, it would be like you had enough money stashed away to be able to live for 7 years without working. On average, that was the amount of capital everyone in Britain had in the year 1700. Now, of course, that capital was definitely not equally distributed throughout the population, so most people couldn't live all that long without working, while there was a tiny minority who could live for literally generations and support not only their entire families, but also a staff of 40 or more servants without ever having to work. That's how much wealth the tiny elite had amassed. The second thing to notice is the great big dip in the value of national capital that began about 1910 and continued to about 1950. Then, the value of national capital began to rise to a level not seen since the beginning of the 1900s. This dip in national wealth reflects the enormous economic shocks that came with the two world wars and the Great Depression. As you can see, the value of national capital dipped down to almost 200% of income, a drop of almost 500%. Clearly, the entire country felt this. The question is, what happened to the distribution of wealth in Britain during that time? As we'll see, this was a time of economic convergence. In other words, there was a dramatic reduction in economic inequality that occurred as a result of those shocks and the policy changes implemented as a result. But clearly, things have changed since then, and there's been a resurgence of national capital. Again, the question is, what impact has this had on the distribution of wealth in Britain? The third thing I want you to notice is the shading used in the table, which indicates the distribution of capital into different types of assets. You can see that the value of agricultural land has declined tremendously, which reflects the shift in the economy from agriculture to industry. At first, this other category of domestic capital took its place. This includes things like infrastructure, factories, and so on. This was reflective of the developing industry and infrastructure. But that also shrank as a result of the shocks of the world wars and the Great Depression. Then the composition of the other category began to shift away from industry and toward finance. So we see it grow again after 1950. Unfortunately, this chart doesn't use different shading for finance versus industry. The other category we see grow after 1950, but especially since 1970, is the value of real estate or housing. As the population grows and becomes increasingly dense, the value of real estate goes up because there's more demand. The last category is net foreign capital, which grew continuously until 1910 and then plunged to the point it disappeared by 1950, and then it went into negative territory since 1990. This basically reflects capital generated as a result of investment in foreign countries. Early investment in other countries took the form of colonialism, and we know Britain was a major colonial power. In fact, by 1910, nearly 200%, 2 years' worth of national income came entirely from what they took from other parts of the world. Basically, this was colonial exploitation. We'll talk more about colonialism in the next video segment. So this was the economic picture for Britain during this time period. For comparison, let's take a look at the value of national capital in France during that same time frame. Turn to figure 3.2 in your handout. France was a bit more wealthy than Britain, with capital valued at more than 700% of national income. Beyond that, the overall patterns are the same. The tremendous dip in the 20th century, the shift in the distribution of capital assets, and the disappearance of colonial-based capital. Now let's take a look at the United States. Turn to figure 4.6. Clearly, this is a very different picture. First of all, notice that the data doesn't go all the way back to 1700. The data starts about the time we became a country. The most noticeable difference is that the US has had far less national capital over the course of its history. We started at just over 300% of national income. Unlike the Europe of the 1700s, capital had to be created in this new country. You'll also notice that the value of agricultural land was very low compared to Britain and France. This is because there was so much of it, and that was taken away from the indigenous population. So very little land was actually being bought and sold. Instead, Much of U.S. capital came from the other domestic capital category, which early on was largely infrastructure and industrial development. Another significant difference is that the economic shocks of the 1900s had only a little impact on us compared to Britain and France. Notice that we had a little setback during the World War I era, but we recovered during the 1920s. You'll also see evidence of the shock of the Great Depression and World War II, but we experienced nothing like the major dip seen in the other two countries. The world wars were not fought here, and so we didn't have to deal with the major devastation to infrastructure that European nations did. And while we were hit hard by the Great Depression, we were still an emerging and developing economy, so we didn't have as much to lose as they did. You'll also notice that our net foreign capital was very small compared to Britain and France. We were never a major colonial power outside of our present borders. Not that we didn't expand our territories, we certainly did, particularly in the Caribbean and South Pacific. You can see that here between World War I and 1950. But clearly, we were not in the same category in terms of being an international colonial power. On the other hand, we dominated and exploited the people who lived within what eventually became our national borders. Stealing land from Native Americans was a significant part of this picture. Also remember that slavery was the exception to our understanding of the difference between capital and human capital. Because slaves were considered to be property and figured into the calculation of a slave owner's wealth, it would be much more accurate if we added slavery into this picture, which you'll see in figure 4.10. Notice how much of a difference slavery made to the overall value of national capital. In the previous chart, we saw that the total was just above 300%. In 1770. When you account for slavery, however, suddenly the national capital is almost 200% higher, bringing the total to nearly 500% of national income. In other words, the institution of slavery represented almost 1/3 of the total national capital for the country. The impact of slavery is even more clearly evident when we directly compare the US with Britain and France, and we separate out the South from the North. To see this, turn to figure 4.11. This table shows the overall national capital between 1770 and 1810. As you can see, the total value of slaves in the South was 250 to 300% of national income, representing half of the total capital in the South. When you combine that with the farmland worked largely by these slaves, it's clear that Southern slave owners controlled as much wealth as the old propertied elite of Britain and France, who had centuries to accumulate their wealth. By contrast, in the North, there were comparatively few slaves, so total wealth was much lower, just above 300% of the national income, and basically only half as much as the wealth found in the South. So while the North was a comparatively egalitarian society, and people just starting had more opportunities to make it, in the South, we find a world where inequalities of ownership took the most extreme and violent form possible, since an elite group of plantation owners owned half of the total population. As Piketty observes, quote, "This complex and contradictory relation to inequality largely persists in the United States to this day. On the one hand, this is a country of egalitarian promise, a land of opportunity for millions of immigrants of modest background. On the other, it is a land of extremely brutal inequality, especially in relation to race, whose effects are still quite visible." End quote.